Hi everyone. So in the previous video we have talked about allocation methods, and in this video we are talking about again different ways of allocation of overhead cost in the organizations. The first one is traditional allocation method. So what is traditional allocation method? In traditional allocation method you will just have one allocation base. So in the previous videos, we have seen that you can have allocation based on different cost drivers, right? You can have allocation based on machine hours, it can be on labor hours, it can be on units, whatever it is. But in traditional allocation method, you will have just one allocation base. So you will add all the cost into one pool, all the cost into one cost pool, and you will determine an just one allocation rate. This is what we call it as traditional allocation method. So it can be direct labor hours, it can be machine hours, it can be space, whatever it is. So every one machine hour, for example, went into the production, you will add certain amount of overhead to the product. This is what in traditional allocation method we will do. We will allocate the cost just based on one allocation base. So this is the example you have here. Depreciation, normally the depreciation value increase or decrease based on the machine hours involved in the production, right? Or you have insurance cost. So the cost driver for insurance is the value of each product. Maybe you have rent, and cost driver for the rent is the space or square feet utilized by each product. But in traditional method we are not considering anything. We are adding all the cost into one cost pool, and in this case we are just dividing that by machine hours. So we are ignoring value, we are ignoring space, we are just allocating the total cost based on machine hours. So this is normally can be used when you make just one product or similar product, because anyhow all the cost will be going to just one product only, and all the cost has to go to one product. So you don't have to bother about segregating different cost based on different allocation base. But if the production is complex and you have multiple products in your factory, then every product is not going to utilize every services equally, right? So in that case, to make the costing accurate, you have to use different allocation base for different services. But in traditional method, we are just following one allocation base. And now we have here a plant-wide and departmental-wide allocation method. This is similar to a traditional method and the other methods. We can say plant-wide means for the complete plant you have just one allocation base. Departmental allocation means for every department you will have different allocation base. So again, this is also based on how many products you are making in the factory. If it is single product or similar product, you can just use a plant wide overhead. But as you are making different products, and all these products are going through different departments, and different departments accumulating cost based on different cost drivers, then to make accurate cost allocation you have to follow departmental allocation basis. So this is an example of I went up, actually I have to go down. This is traditional allocation. So this is what actually departmental overhead allocation is. We can see department 1, it has its own allocation base, which is $3 per labor hours, because their cost is mainly driven by the laborers who are working there. But in department 2, the cost driver is machine hours, because maybe this department is using more of the machines, less of the labor. And department 3 is like cost driver is space, maybe this is the storing place. So here cost is increasing or decreasing based on the space utilized by each product. So here it is feet, and you can see here you have $3 labor hours, $3 of overhead cost per labor hours. Here you have $3.75 dollar per machine hour. Here you have $5 per square feet of the space utilized. So any product getting services from each of these three departments, they will get different rates based on how much they utilize the services of these three departments. This is what departmental overhead allocation. So here you can see this heading I need to change. It is not traditional allocation method. This example, this is planned. Okay, this is planned allocation method. So all the department 1, department 2, department 3, all the cost is going to one cost pool, and you just have one allocation base in planned based allocation method. But in department based allocation, you will have different allocation rate for different departments. Now we are determining the level of activity, or we are determining the denominator level or allocation base for any activity. We know that when we use a lot of allocation base in our estimation, our POR is going to be low, right? And when we use very low allocation base in our estimation, our POR is going to be high. So POR high means the total cost of the product is high, and POR low means the total cost of the product is going to be low. And when we are setting a price for the product, when you have lower cost, maybe you will add a margin on this lower cost and you will set the price. Whereas in other case, maybe you will have the higher cost and you will have a margin on that higher cost, or markup on that higher cost. Okay, so we have to be careful when we are deciding on the activity level of the department or service. So we can be optimistic, but too optimistic means price will be too low. Or if you are too pessimistic, then the price will be too high. The allocation rate will be too high, right? So you can see here an example. 1.5 million is my overhead cost, and here I am too optimistic. So I said I will have 500,000 of labor hours for the period. So every unit or every labor hours went into the unit will add $3 to that product. So here my allocation base is 500,000. But you can see here I am too pessimistic. It is only 300,000 I am expecting. The direct labor hours for the year is only 300,000. So if this is the case, then the per unit or per direct labor hour cost went into the unit is going to be $5. Whereas here it is going to be again different. It is going to be 3.75. So you can see now here, based on what allocation base you are using, your POR is going to change, and based on this POR your total cost is going to change, and based on the total cost your selling price also may change. So how you will determine this level of activity? You can determine the level of activity based on two factors. One is how much we can supply, and the second one is how much we will have demand. So how much we can supply means maybe I have a machinery that can produce 1 million units in a year. So this is the theoretical or ideal capacity, we can say. When you buy this machinery, the manufacturer said in the ideal situation, most efficient level situation, you can make 1 million units. So if you take the total cost and divide by the total cost by 1 million, then per unit cost is going to be very low. But later you know that I cannot make 1 million. Practically it is not possible, because you will have idle time, you will have downtime. So maybe I will produce 0.8 million only. So in this case, you will take the total cost and divide that by 0.8 million. That means your per unit cost will increase now. So this is based on how much we can supply. Now I have capacity of 1 million, but will you be able to sell 1 million? Maybe not, right? Even though I have capacity of 1 million, I have a demand of 500,000 only. So this is what we call it as expected actual capacity or master budget capacity. Okay, so here we are expecting my demand is going to be 500,000 only. So I will take the total cost, divide that by this 500,000. So my cost is now going to increase. And this is normally for master budget is normally for 1 year. So this you can use for short-term pricing decisions. Other one you have is normal capacity. So normal capacity we will consider the capacity you are going to achieve over 2-3 years. So that means you will consider the seasonal variations, cyclical changes, all that going to happen in your demand. So you will take 2-3 years demand and you will take an average of that. Maybe that is now only 0.4 million. So now again you will take the total cost, divide that by 4 million. So your total cost per unit is going to be high in this case. Okay, so these are the level of activity that we can consider when we are determining the POR. And as per US GAAP, we can use normal capacity or specifically prescribe. US GAAP is prescribing it is better to use normal capacity, or we have to use normal capacity for external financial reporting. Now this is going to be again discussing about the capacity utilization. So we are talking about pricing decision here. If the capacity utilization is being used in pricing decision, the use of normal capacity may result in fixed overhead cost being spread over small number of output units, causing high per unit cost. So we said this, when we use normal capacity, that will cause cost per unit will be increasing. This result in high non-competitive selling prices. So when your cost is high and if you are setting your price based on the cost, you will end up in high selling price. So when your price is high, maybe your demand will go down, and this will lead to a phenomena called downward demand spiral. So we will see in the coming slide what is downward demand spiral. You can see here I am expecting my cost is going to be 1 million and I am going to have a sale of 400,000. Okay, so my per unit cost is actually 3.75. So your expectation was I am going to sell 400,000. But how many you sold actually? 300,000 only. You sold only 300,000 in the current year. So next year when you are making the estimation, you will not use 400,000, right? Because you know that I sold 300,000 only last year. So I will take 300,000. Now my cost per unit is again increased by $5. That means my selling price will increase now. Because my selling price is increasing, my sales will go down again. And actually you sold only 200,000. And third year when you are doing an estimation, you have to consider 200,000 because this was the actually happened last year, right? So you are taking the 200,000 and dividing the cost by 200,000. This will make again your cost to increase, and that will result in increase in selling price, and increase in selling price will result again in demand to go down. So this concept is what we call it as downward demand spiral. So what is downward demand spiral? Is a continuing reduction in demand that occurs when costs are too high. When the cost is too high, you are getting continuing reduction in demand. That is what we call it as downward demand spiral. Now this already we discussed over and under applied overhead, and we have discussed this also. A debit ending balance in factory overhead control account means overhead was under applied, and a credit means it is over applied, right? So now you found that there are some balances. It can be debit or it can be credit in your overhead control account. And we said when it is debit means you have under applied. All the cost has not gone to your work in progress. If it is credit balance means you over applied and more of the cost went to work in progress than you actually spent. So now we can say your costing is wrong. When there is a balance in overhead control account, right? Your costing is wrong, because in one scenario we are not sending all our cost to the work in progress, and in second scenario we are sending more cost to the work in progress than we spent. So this has to be rectified. How we will rectify this? We will take the balance, how much we have balance in your overhead control account, and that you will add or you will remove from the work in progress. If you applied more, you have to remove, right? If you applied less, you have to add to the cost of the product. So you will check first actually how much I spent and how much applied, then minus applied from the actually spent. If it is a positive amount, we can say that is under applied. That means actual cost is more. If it is negative amount, we will say it is over applied. Why? Because actual cost is less. That is what making this number to be negative, right? And this differences, what we will do, this difference end of the year we have to nullify this difference. We have to make this difference zero. If this difference what we have in your overhead control account is immaterial, or we can say from the perspective of that company it is very small, then we will not bother much. We will take this cost and we will add or we will remove from cost of goods sold. So whatever difference we have, we will add to cost of goods sold or we will remove from cost of goods sold. Okay, so if you have debit balance, that means you under applied, right? So what you will do, you will debit cost of goods sold and you will credit overhead control account for that particular under applied amount. If it is having a credit balance, that means you over applied. So what you will do, you will credit cost of goods sold and you will debit overhead control account. If this amount is immaterial, it will go directly to cost of goods sold. But when this amount is material, this amount is big, then what we have to do, this amount we have to allocate to work in progress, finished goods and cost of goods sold. Why? Because you have some cost here that is still lying in your overhead control account, and this amount is considered as a big amount for that company. Then your costing has to be accurate, right? Because whatever the cost we have in overhead control account, that cost has to go through work in progress, then to finish the goods, then to cost of goods sold. And you know that some goods are still on work, and some goods we completed and some goods we sold. So this cost has to be distributed between these three inventory categories. Based on what? Based on the proportion of units they hold in each inventory category. So for example, if it is 90 units and 30 units in work in progress, 30 units in finished goods and 30 units you sold, then the total cost you have to divide equally between these three products. If it is $90 difference is there, then that means $30 will be added or removed from work in progress, $30 from finished goods and $30 from cost of goods sold. So this distribution is made proportionally to each of the three accounts based upon the number of units in each of these three categories. When it is material amount, we have to do in this way. If it is immaterial, we will only consider cost of goods sold. We will add to cost of goods sold, or we will remove from cost of goods sold. So that's about cost allocation. And here we have a small topic. We have to discuss this also. Different accounting systems or different cost accounting systems. So we have cost accounting system, which is actual accounting system. So in this actual accounting system, what we are going to do is, we don't have any concept of allocation or standard costing. What we will do is, we will take only the actual material, actual labor, and actual manufacturing overhead, what we spend. This is how we are going to calculate the cost of the product, by taking all actual cost. That is actual accounting system. And when it is in normal accounting system, we will take actual material and actual labor, and overhead will be applied. Manufacturing overhead will be applied. This is what in normal accounting system. So here we will be using standards. But in standard costing system, everything will be standard. Budgeted material you will consider as standard. Labor what we used, you will take standards, and also budgeted overhead also you will consider standard price only. So we have an example here. In the coming slide. So actual costing, as we said, actual cost is directly traces all the cost of the product, giving clear picture of the actual expenses. Standard costing uses historical data or standards to set benchmark for the cost, focusing on analyzing variances to improve the production process. So here we are using standard costing. In detail we will be studying this in section C. Then we have normal costing. As we said, it's a mix of actual costing and standard costing. Okay, so we have an example here. We have a bakery that makes a batch of 100 loaves of bread. Their actual cost of flour is $50, actual labor is $40, and actual cost of utility is $10. So they took the total cost as 100, 50, 40, and 10 divided by 100 loaves of bread. That means 1 per loaf. The cost is going to be $1 per unit when we use actual system in this case. But imagine we use normal costing. So we said in normal costing we will consider this actual, but this is going to be applied. Okay, so here we will see actual cost is 50, that is fine. Actual cost of labor is 40, that is fine. But here we have an allocation. Let's assume bakery calculates overhead rate based on the labor hours. So here we have seen our overhead is $10, and this we are going to allocate based on labor hours. And if the batch of 100 loaves took 10 hours, okay, this is taking 10 hours, then the overhead applied would be 10 hours multiplied by 0.2, because we have decided here per labor hour cost is $0.2 or 20 cents. And when you make 10 units of this bread, only $2 will go to the bread. So here our cost is going to be 92, 50, 40, and 2. So now you have a variance, right? You actually spend $10 in overhead, but you applied only $2. That means you have a variance in this case by $8. Okay, so this is normal costing. When it is standard costing, as we said, here we have $50 actually spent, here $40 actually spent, here $10 actually spent. But in standards, we will not consider the actual cost. We will take the standard cost that we set. So what is standard cost? That is the cost that we are setting in the beginning based on our historical data. So we know that to make 100 loaves of this bread, I need flour worth $45, labors it has to be $42, and standard utility is going to be $8. These are the standards. So you will take 45 plus 42 plus 8. So that is going to be $95 to make 100 loaves. That means it is going to be 0.95 per unit. So again, here also you have differences, right? Here actual cost is $50. So we have $5 difference or variance. Here we have $42. That means labor was 40 and you spend 42. So again you have $2 spend extra. So there is a variance. Here it is $8. Here also you spend less than the standard. So you will understood that there are some variances and we have to account for it. This we will study in details in section C, how we are going to find out the variances, how we are going to account this, all those things that we will study in section C. So here we have to see three methods are there in costing. Three costing method. One is actual. Here we will use all the cost actually we spent. We'll consider only the cost actually we spent. In normal accounting system, we will consider actual material and actual labor, but overhead will be applied. In standard costing system, everything will be based on standard. Okay, so that's it about this presentation, and I hope we have completed the basis of costing in a better understanding way. And if you have any issues, problems, please feel free to contact me and we can discuss further in a Zoom meeting or personally, whatever it is. You can always call me back. Thanks a lot for watching. Thanks a lot for being with me.